Yeah, I've been away from it, Marcus, but we used to focus on triple C. They were one of the significantly large tier of debt in the high yield space. Triple C was like the lowest rung. You go down to triple C minus, and after triple C, it was default. So if we start seeing more and more companies with those ratings coming to market and issuing, it was a sort of a sign for us that look at people are loaning these companies money, purchasing their debt, and their financial metrics, their leverage profiles, and their ability to service that debt are very, very weak. But you'd hear, well, people have money to put to work, so we have to buy something. We're afraid just to sit on the sidelines. I get nervous about the rise in triple C, and the high yield market was always a good indication because as spreads blew out, they were termed like the smart money. They were able to understand when the economy was all of a sudden going to turn south, like a precursor to potential economic economic deterioration. So we always kept our eye on that. Today, again, we've come through an earnings season. The earnings were pretty solid for the big names. We don't see, high yield uh, interest rates or debt rates are in the mid six. So not something to get alarmed about. When you see spreads blow out, spreads, I mean the rate over treasuries, because treasuries are the primary, they're considered non-defaultable, and all other rates typically key off of that in the corporate space. It's treasuries plus. So spread over treasuries. That's the amount that you need to be compensated for the risk you're taking on and lending money to that entity or company. So the higher the risk, the higher that spread and the higher the yield or interest rate needs to be. So keeping your eyes on that. And they haven't blown out. We haven't seen any dislocations yet. At least I'm not aware of any. But again, I'm not in there every day like I used to be. So is it a problem when you see a lot of these big players like Oracle's issued a ton of debt? Now they have triple B ratings, so they're probably in the middle of investment grade. So not overly concerning, but we'll watch those. The more that gets issued, potentially that could trigger a problem, more debt that they take on. So I haven't seen it. I know Microsoft, Meta, Amazon, they're spending huge, right? Hundreds of billions of dollars in CapEx. Some of them are issuing debt. But these are companies that just have gargantuan balance sheets, billions in cash, and um, it's just not an issue. They're AAA rated at Microsoft level, and the other one's a double A. So I think the Mag 7 are very, very strong, maybe with the exception of Tesla. Tesla's, I think, triple B, but I don't have an issue with regards to them. But it's important to watch other issuers, watch those high yield spread levels, and see where they go. But earnings have been good. The guidance given by many of the companies, we're not finished earnings season yet, of course, but I think what we've heard so far is pretty constructive, pretty positive. So I don't there's nothing I can foresee. But Marcus, you know as well as I do that doesn't mean we can't have like some event that comes out of the woodwork and that no one was focused on.
One.
Yeah, so I don't know, you can't discount that. But you mentioned another thing, credit default swap levels. Credit default swaps were developed to sort of offset the risk that the banks were taking when they were loaning money to companies. And, you and I spoke offline about this with Enron. When Enron was coming along and, you know, they were issuing all this debt and they were the darling company. Everyone was investing in them and buying their debt. The banks who were loaning them money were buying credit default swaps. No one knew to ask the question, why are they buying? Who's buying? It came to light after the fact, but that's like a perfect example. But keep your eyes on credit default swap levels because they're also a great indicator. Each country has a sovereign credit default swap level, and developing countries or emerging companies will have much higher credit default swap levels. The U.S. is pretty good, but there are countries that are tighter. There's still AAA countries like Switzerland, many of the Nordic countries. Keep your eye on CDS levels. High yield levels. I think those are good sort of read throughs to think about how sophisticated investors are thinking about risk. But again, to your point, something comes out of the woodwork. You never know. It's hard to plan for those, but absolutely possible.